The Federal Reserve has just announced that they plan on raising interest rates 3 times in 2022, affecting everything from mortgages to credit cards to student loans and potentially even your own job. And of course, inflation. That's the reason they're doing it. They're trying to cut back on the runaway inflation. Inflation is up nearly 7% year over year, with gas prices, food, and of course, labor costs going up dramatically over what they've averaged over the last several decades. That's why the Fed is doing this. So why is the Fed doing this exactly now? What changed their mind, and what does it exactly mean, especially for you? We're breaking it all down in this video, explaining what it means to have quantitative easing and tapering, all of these fancy words. I promise you, it's really not that complicated. And once you find out how massively bad the Fed got it wrong over the last few months, and the departure and the switch all of a sudden, you may have second thoughts about exactly the credibility of the Fed, and I wouldn't blame you for that. So anyway, my name is Kevin Conway. If you like stuff like this, then join me, like this video, and subscribe to the channel. With that being said, let's get right into exactly what is going on, and then we will explain it. So the Fed is raising interest rates 3 times next year if all goes according to plan. Now, what does that mean exactly? Well, the Federal Reserve of the United States of America is actually the benchmark rate for basically all lending across the entire country and across the entire world. So whatever interest rate the Federal Reserve sets, every other rate is basically set against that rate. So if the Fed raises interest rates, all other interest rates correspondingly go up. Now, why is that the case? Well, that's because when the Fed raises interest rates, that is a borrowing cost for the United States of America. The United States government is considered the lowest risk borrower in the country, and for good reason. They could tax you, they could take your money at any time, they could print new money, they're going to pay back their debts. Unlike you or me or a company, which can't just print money at will, cannot just tax other people at will, it has to provide a good or a service. The United States will find a way to get money to pay back its bondholders. Therefore, people consider it to be the lowest cost borrower. So if the cost of the United States debt goes up, that means the cost of everything else, which has more risk than lending to the United States government, also has to go up. This is why when the Fed raises interest rates, everything else also raises in cost. This is really the core function of the central bank of the United States. Other areas have central banks as well, such as the Bank of England for England or the European Central Bank in Europe more broadly. The European Central Bank, for example, has interest rates currently at negative 0.5%, which is totally complicated and can be explained in another very detailed video. Very fascinating. The Bank of England, by contrast, had interest rates at 0.1%, and they raised it just today to 0.25%. Now, the United States has basically an interest rate right now from the Fed of 0 to 0.25%. They plan on raising that over the course of the next year to around 1%. Now, why are they doing this? Well, interest rates rise and asset prices fall. If asset prices go down, then interest rates are usually going up as well. So there's this relationship where interest rates can control the rate of inflation of asset prices, and as a result, a downstream effect of everything else from goods and services that flow off of that. So what does that exactly mean? Well, if borrowing costs are higher for you, for example, if you're looking to get a mortgage, well, you're probably going to buy less house. If it costs you, say, $4,000 a month for buying a house when your interest rate is 5% versus $3,000 a month if your interest rate is lower than 5%, well, you're more likely to buy a house if it is the latter as opposed to the former. Therefore, you're an extra buyer, you're a marginal buyer in the buyer pool to buy a house, which means prices will go up because the highest and best bid will win the prices of the house. So that's how interest rates are lower, can stimulate demand. And conversely, when interest rates rise, demand is lowered as well. That's what the Fed is looking to accomplish here. They're looking to lower the demand for goods and services by raising interest rates so that they can control inflation. We had this once before in 1980, 1981, 1982, when the then current chair of the Federal Reserve, Paul Volcker, actually raised interest rates to close to 20%. Totally killed demand, created a huge recession, but got inflation under control. Previously, it was double digits. After that, it was around 3%. That's the central goal of what the Fed is trying to do. The Fed has also done something called quantitative easing. Now, quantitative easing is a fancy word that simply means the Fed is going to print money in its backyard and send it out into the open market to purchase assets, whether they be real assets or financial instruments like mortgage-backed securities or something like that. Now, why would the Fed do that? Well, there's really two reasons. One is a direct infusion of money into the economy. It's simple. They print money in the backyard and then they go out and they purchase assets from somebody else. If I have a mortgage-backed security and I sell it to the Fed, well, the Fed just paid me real cash. Now I have cash. Cash is in the economy. The Fed just injected that cash into the economy. It didn't exist before. Now there's more money in the economy, more money supply, and more money supply leads to higher inflation. So they've done this as a result of the COVID-19 pandemic, and they want to taper that. They want to stop doing that over time. They want to reduce their purchases over time, which they said they plan on doing by March. The Fed is going to reduce its purchases of assets every month until March. Now they do it for, number one, injecting cash into the economy. The second reason they do it is because when the Fed purchases assets, that means it's crowding out other buyers in the market. It's buying an asset and bidding up the price. Now, if you have, for example, a bond and it costs $100 and it produces $1 every year of income, that has an interest rate of 1%. That's $1 divided into the cost of the bond. Now, if the Fed comes in and says, I'll buy the bond for $200, well, all of a sudden that bond is now not yielding 1%, it's yielding 0.5% because the yield changed as a result of the price of the bond changing from $100 to $200. It's still producing that $1 of income, and you divide that now into $200. That means the yield drops as the assets increase in value. That's the goal of the Fed in tapering. They want to produce a lower interest rate environment, a lower yield environment to stimulate demand. If they come into the market and they purchase all these assets, all of a sudden the yields are much lower, and that stimulates more people to say, hey, I'm going to issue a mortgage-backed security because I'm getting such a low yield and as a result, a high price for that. This creates more risk-taking from investors out there. This is also why the stock market has gone up in value, because if you have a stock that yields a certain dividend and all of a sudden everything else in the world is yielding lower, your value becomes much higher, your stock value goes up in value, which is why the stock market has gone up dramatically from its low in March of 2020. That is a result in large measure of the Fed doing quantitative easing. Now, this is controversial because you and I can't just go print things in our backyard, print money and purchase things out in the open market. The Fed can. That is a contentious point. Some people think the Fed shouldn't be able to do that. It leads to excessive inflation, and they wouldn't exactly be wrong right now. The Fed actually got it wrong right now. They actually said for a long time that inflation was so-called transitory. It was here for a short period of time. It wasn't going to be long-lasting. They said that inflation was transitory because it was a result of short-term price bottlenecks, supply chain bottlenecks at, for example, the port of Long Beach. There weren't enough drivers, there weren't enough ships unloading docks, at the docks to actually get goods and services out, which meant there were fewer goods and more people buying the goods, and therefore higher inflation. But once we had enough people unloading the docks, all of a sudden there would be enough supply and there wouldn't be as much inflation. Well, that turned out to be wrong because we've had increased supply as a result of more things moving through the ports, more people working there than there were before, and inflation is still really high. You still have high gas prices, high food prices. I'm sure you've seen it too. I've certainly seen it. I mean, it's crazy. I used to go to Trader Joe's and get bananas for like 19 cents. Now they're like 70 cents. I mean, that's remarkable. And that happens across everything. Everyone's seen it with gas prices up more than 50% year over year. It's affected basically everything in the economy. And the Fed said for a long time it was transitory. And then recently they said, oops, we made a mistake. It's not exactly transitory. It is here to stay, which is why we're going to raise interest rates and start tapering our quantitative easing. That's basically what the Fed is doing right now. So how does that affect you? What should you be doing? Well, in a rising interest rate environment, typically asset prices fall, which means the stock market may not go up as much. It still may rise, but not as dramatically as it has been in the recent past. It also means that your debts, if they're variable rate, meaning they change in interest rate every month, those debts will go up. They will not go down. they will go up. If you have a fixed mortgage, that is fine, but just know that if you're looking to purchase a house and get a mortgage, you're probably going to get a lower interest rate now than you will a year from now. If you have a student loan which is tied to some variable rate instrument, it likely will go up. If you have credit cards especially, it will go up. Your interest rate will go up. I always say never try to carry a balance on your credit card, paid off in full every month, but if you do, just know that it will go up. Conversely, if you're looking to get a savings account or a checking account and you're looking to get some interest, right now it's pretty low. There's not very much interest out there in all these bank accounts because of the Fed. Now, if the Fed raises interest rates, that affects everything else. I have a video detailing exactly how. But if you're looking for a good checking account, I have a link in the description below for SoFi Money. Check it out. If you want to do that one or some other one, just know that you will have a higher interest rate on your savings account more than likely a year from now. So it's kind of, it's good for some people, bad for other people. But overall, the reduced demand and the reduced supply of money into the market may lead to a recession, which is something to be concerned about. Anyway, that was kind of a lot. If you have any questions, leave them below. I love this stuff, so please comment, and I love to respond to all of you. Leave any questions you have, and I will be making also a series of investing videos on how to invest in the stock market, step by step, explaining terms, explaining exactly what's going on, how to invest in real estate, which is actually what I do full time. So if that's interesting to you, or you have specific comments on that you'd like to know, please leave it below. I love to hear it. So with that being said, I'll see you next time. Thanks.